Ladies and gentlemen of the crypto space, we're live on a Monday, May 1st at 11:31 a.m. Well, check this title out. Check it out. There's a significance to meme coins. And we're going to talk about a 3-year time horizon, of course. So the significance is meaningful. They're popular, they're attractive. Most importantly, they're permissionless. Aside from the risks associated with participating, the volatility and what is the psychology of the prevailing actor and the experience and the goal, the individual goals of persons engaging with such assets, it's a very complicated, yet simple. It's a simple psychology to understand, but it's a complicated game to play. Very different than other financial markets. It's pure player versus player. It's pure who flinches first. So it's a pure game of assessing market conditions, and it's a gun duel. It's who flinches first. And that's a game that many people like to play. I don't play it, and that's okay. It's okay for you to play it. It's okay for you not to play it, so on and so forth. The point is, it's permissionless. And we're not going to talk about the frauds. We'll talk about ones that have been released, created with at least reasonable intentions for actors to engage with them in just a pure player versus player format. Clearly, the extent of frauds out there is extraordinary. So we won't even get into that aspect of the market, and we won't even get into the regulatory considerations of that. They're almost irrelevant, in my opinion. So, for the legitimate meme coins, this is a re-execution of 2017 and 2018. In fact, one of the more popular meme coins is Pepe Coin. Pepe Coin was something that was, at least there was the exact same coin in 2018. It was associated with a project called Memetic. So this is a reincarnation of the exact same phenomena. Now, it very much has a capacity to traverse a different capital path. It has a potential to do what the other meme coins have done. And that is, it's interesting to me, not from a sense of potential capital return, because I don't have an interest in participating in that type of environment. But I'll return again to the concept of permissionlessness. What does that mean from capital flow? It means capital can flow in and do whatever it wants. So from a general public gambling perspective, okay, that's significant. And it's not just the general public of a particular country. It's not just the United States. It's not just any particular country. It's all countries. So capital flow has a potential to come into this emerging market from all countries, any language. And clearly, a lot of coins do translations, especially as more market actors pile in and more people reap gains. They tend to create a community, and they tend to spend capex to facilitate the brand reaching more and more persons. And stuff like Hex. Hex has done exactly that, to such a degree that they actually had a traditional mail campaign, physical postal mail. Now, that's not the future of finance. Finance is credit and capital formation and leverage, and those are financial products and services. The creation of currency is what manifests from credit, so that's obviously significant. So, what are these meme coins? They're not significant from a financial
infrastructure perspective, but they're significant from the permissionlessness, and they're significant from the psychological changes that are occurring in society with regard to disparity and seeking of opportunity, neglecting risk more and more. So this will have an impact on the broader financial system. Obviously, this is completely occurring in traditional financial markets when you look at the equity indices, um, but it will occur to a different degree in the crypto space, which is exactly what we've seen in 17 and 18 and what we've seen again 2020, and we will see again in the future as there's more currency units available, as people have more liquidity for whatever reason. They will engage in this type of activity and crowd into assets that don't have financial significance, but that doesn't mean they don't have significance. They are telling us a story of general public sentiment and it's not even need, it's maybe somewhat of it's a desire, um, but but it's certainly the choice that people are taking to engage in this kind of activity. So what does this mean for the broader DeFi space? And that's what I find the most interesting. Permissionless capital movement means that any capital from any country, from any source, can flow into the crypto space. And that's a form, or as a destination for regulatory arbitrage unto itself. Um, because capital can flow between countries, but this isn't associated with a particular country. You don't need to go through the New York Stock Exchange to gain access to these assets. You can access these assets from anywhere in the world as long as you have a pathway to acquire either a volatile asset or a stable asset. A stable asset ultimately is an asset, so it's any of the assets, stable coins, or maybe these meme coins, or uh, whatever denomination you could think of. So this is basically describing non-banks that fall outside traditional banking regulatory uh, uh, purview or scope. So, but that's a global landscape. That's not just the non-banks in the United States. That's not just European or Southeast Asian, Singapore. It's just any company in any country that wants to facilitate this type of enterprise, be it capital flow, on-ramp, off-ramp, or credit. So that would be interesting. Traditional brick and mortar offering credit facilitated by just Aave. I mean, it'll start small because Aave is relatively small with a couple $1 billion. Oh, that's small, but that is small. But it's going to get bigger as traditional banking offers more friction. That's why I started this out with meme coins, because it's permissionless. There's no friction to engage with anything you want to engage with. Therefore, from a credit perspective, if you need credit and banks are not offering credit, at least to the degree that they have historically, maybe a month ago at this point, this is a place that you can acquire credit. Now, clearly, it's not $500 billion worth of credit. You know, you may need $100 billion to deal with First Republic, so you're not going to be able to get that in the crypto markets. But that's the point. This is the start of this emerging market that offers these types of products and services. There's these types of enterprise servicing real world enterprise. But what's the difference between real world and these types of markets? Is it a boundary? Just because it's virtually accessible doesn't mean this isn't real world. So I'm not too fond of that boundary. These are just enterprise that offer financial products and services. So I think the market we're in, where we're seeing these banks fail and everyone's talking about credit contraction, which is coming, if not here, to a great degree. Um, Let me pull up some charts also while I talk in the background. And we're talking about contraction of currency units, but that's not really occurring at all. From a global perspective, we're talking about, oh, where's my chart? I had a nice chart. It was somewhere. Did I not have, oh, talk about not being prepared. I'll talk with this chart up for now. So, well, let's put it up. Let's do the chart that I really need. USM2. So with credit contracting as banks are more fearful and QT continuing, Lynn Alden talked nicely that the banks have a little bit more runway because the smaller banks will fail. They'll get absorbed by the larger banks, and they have more buffer. So the Fed could do a bit more QT. They're probably going to do the 25 basis point raise. And whether we see an event, a credit event or not, is irrelevant to the directionality of the system. The directionality is set in stone because of GDP. GDP is going to contract because of cyclical reasons, the business cycle, which is coming to an end and it's starting to bottom, as Raul talks about very nicely, but also mostly demographics. So they print the difference, which we see obviously in US M2 since 71. But then if you see the top here, and now let's throw in Europe. So a little bit less of a dip, but then let's throw in Japan. So Japan single-handedly accounted for all M2 contraction of Europe and the United States. This is a currency unit, and notice I thought the denomination was trillions. All right, let's go to M2, CNM2, and look at China. China blows it through the top. And that, to me, indicates that it's a global system of currency units that we're interested in, and not just the United States, because the crypto markets have sustained themselves. There's not been 30, 40, 50% continued capital flight out of these markets, so there's still a tremendous amount of currency units in circulation. And this also indicates that the world doesn't tolerate an extended contraction of currency units. Either one country or another is forced to pivot sooner rather than later. And Japan and China has done exactly that. So they were the first to flinch with regard to currency unit contraction. They don't want credit contraction. The debt-based system is dependent on currency creation. So inevitably, the United States will have to adjust policy to continue currency unit expansion, otherwise the whole system falls apart. And we're talking about the most favorable path forward. It's either deal with, significant portions of all enterprise in countries failing, like we've seen with very small emerging markets. Horrible news stories we see out of Africa almost daily. And would the United States tolerate that type of environment? And the answer is obviously no. So the only way to accommodate the GDP shortfall, considering demographic changes and overall productivity declines that we've experienced, is to paper over it and stabilize everything, and then somehow figure out how to finance productivity enhancement. And we'll get to that. But the point of all of that is, look at the amount of currency units in circulation. They're not decreasing. Look at the need for productivity growth to bolster GDP, ultimately to service, to to further enhance tax receipts so you could service national and debt obligations across the board. This is all heading in one direction. There is no down direction. You're going to have the volatility of down. It'll be transitory down. So from a down perspective, the only thing to consider is how cheap you could get assets that are going to do what you want them to do. Are they going to be meme coins? Is that what you're interested in? Are they going to be enterprise assets that serve as cash flow? Are they going to be collateral assets that are significant from a collateral perspective to facilitate currency creation? Credit. You use them to borrow against. So this is prime time to figure out who you are, what you want to be, how you want to structure your capital, how you want to engage with markets. Because it's coming. And that title, the title of the stream, 3-year time horizon. I say 3-year time horizon because of the dollar. This is an extraordinary chart, and I'll explain why. There's been two primary strong, pronounced down cycles in the dollar that you could isolate where the crypto markets experienced their runs. 16, 17, 18, 20, and 21. Those were what everyone calls the bull runs in the crypto markets. And that's these two purple boxes on the screen. That's it. This is a 6-month chart. Don't look at the short-term charts. They'll drive you nuts. So over the next 1-2 years, I'd say, probably about 2 to 4 candles on this chart, we're going to see what happens with the time-weighted average price. We have never seen an environment in the crypto markets where the DXY pushed significantly below the TWAP on the 6-month and held it as resistance. So we're not even there yet. So we have to first get to the encounter with the TWAP and see if it pierces it, much like we did in 2020. We pierced it to the downside, and we didn't hold it as resistance. So obviously there's all the geopolitics and the relative nature of central banks and the relative nature of foreign currency pricing, currency pricing in general. So there's all that complexity aside. This chart is a broad representation of dollar forex versus Japan mostly, and the euro is the second largest component. So this gives you a good perspective of the dollar's relative strength to most currencies around the world, particularly because everything else is paired with euros and yen as well. So plus is the history of this chart. So you can get granular, is my point. You can break down the dollar versus any currency you want to get more granular information. But this chart, generally speaking, gives you a broad way to inspect the dollar's value relative to most other currencies, generally speaking. So over the next 2 years, we get to see how the price point interacts with this average price trend. As the dollar depreciates relative to other currencies, there's a significant increase in liquidity, available capital to engage in business and financial activity. And this is exactly why we've seen the two purple boxes express the most bullish environment for the crypto markets. Now you're trying to tell me, after a shooting star like that ended in Q4 2022, basically October, so much confluence surrounding October. You talk about Raul with the ISM, or you talk about what move bond market volatility. It's just written all over the charts. And you tie that in with the geopolitical conversation of what U.S. did against Russia and the sentiment that everyone hears about with regard to BRICS, what Drunkmiller says with regard to his dollar bet. That's probably his sentiment is a combination of all those factors. There's a very strong, at least short-term trend where countries and individuals are pulling away from the dollar, which will strengthen foreign currencies. And this is the best representation, in my opinion, of global liquidity conditions. So I like his bet. I like the way this looks for the next couple of years, and I think we're going to see some very pronounced capital flows into permissionless markets that don't have to deal with the regulatory hurdles of sovereign nations, because these markets will offer these financial products and services no matter what any country says from a regulatory perspective. If your company is on the line and no bank in your region is offering you capital, they won't extend you credit because they can't take the risk. This market will offer you credit permissionlessly. I need to borrow X amount of dollars. I have whatever I have collateral. So the real world asset narrative is meaningful because folks will want to access equity in their assets. And companies have balance sheets and they need collateral on the books and they want to access the equity in that collateral. They could do that by transferring some of the value, some of their balance sheet into collateralizable digital assets. So they could always do the balance sheet game of restructuring their debt, borrow other capital, pay this, access collateral, and then liquidate collateral. That's the worst case scenario. But that's the whole point. The whole point is it's all permissionless. Anyone could do whatever they want, which means it's the ultimate regulatory arbitrage. So this looks wonderful from a 3-year time horizon, in my opinion. And I think the simplest way to engage with crypto markets is not to expose unnecessarily to risk. You don't have to do any of that. That's the whole point of the stream. The whole point of this stream, especially opening with meme coins, is yes, you can make significant returns on meme coins. And that's okay. But you don't have to engage with this market like that. You don't have to succumb to base human desire to become a multi-millionaire. You don't have to. If you turn $1,000 into $20,000 or $20,000 into $500,000 or $100,000 into $5 million, pretty sure that's pretty cool. Pretty sure that's pretty interesting from a story perspective. Friends and family, you play with the crypto markets. You're gambling. Oh, no, I'm not gambling. And that's what you can say if you choose to engage with these markets with this type of rigorous analysis, rigorous narrative, tying things into the greater financial markets. Or you can participate in the cultural shift, the demographic divide, different age groups feeling different financial pressures and feeling like they're forced to engage in this type of gambling activity to make significant gains. The majority do not make gains on assets that are very popular right now. The majority will not make money on Pepe. The minority will. That's how it works. And I'm not critical of any of that. That's okay. If you make gains, you make gains. But don't do it with hope. Don't do it with blind eyes. Either you're a professional or you're gambling. And I'm not fond of gambling. I'm fond of being quantitative and strategic and having a frickin' awesome story about the future of France. You guys know what I'm talking about. Got a pretty decent story about why the crypto markets, which mom and pop think is a casino, we have a good story why it's actually
very important to the global financial markets that are going to be experiencing significant structural changes over the next years. And within 3 years, we're going to see some interesting FX market changes. Exactly what we're looking at right here. And dare we break the TWAP in the next 3 years, I think Druckenmiller is going to be like, whoa. Because then you're going to get some lows. Is it a fresh lower low? Because since 1968, there's been 3 bullish cycles for the dollar. The dollar has been bullish since 2008. This is a straight bull run. These are intra-market transitory ups and downs. Everything the crypto market has experienced was a transitory dollar decline. And we just hit a candle that looks like this? Look at the last candle we saw, last blow off top we saw. And this one is bigger. This has a bigger candle, less of a body. It was in January 1985 when the dollar just fell off a cliff for 1, 2, 3 years. How do you like that? For 3 years, the dollar ferociously declined from like 160 something. Oh, if my computer will behave. 164 down to 85. And then it takes all these years in between of horizontal price action to get another dollar rally. It actually seems relatively hard for the dollar to rally. You know, interestingly, as Brent would say, the dollar rallying is organic because of the global debt load, and to service the debt, that puts pressure on dollar forex. But it seems to be the case that after '08, the world has opted for eurodollar printing using collateral to create dollar currency units much more than dollar forex. Otherwise, you'd have much higher peaks in the DXY as the demand for dollars only has gone up, especially since '08, but certainly since 1985, how much dollar debt is there. But why hasn't the dollar hit a fresh higher high? It's been decades. And even in 2001, the dollar didn't hit a fresh higher high. Not even close. I mean, look, you have to get above $1.60, but it was a lower high. And most recently, it's not even a fresh higher high. But note that in '08, that was a fresh lower low. That was certainly a lower low than 93, and certainly a lower low than 87, than all the time frames and even earlier. This is a directionally downward chart, and albeit it's not organic, I like Brent's theory, the milkshake, for the destination where they lose control. If they lose control, there goes the dollar, goes to the upside. You got non-banking crisis, as Yellen talks about, and foreign currencies are just evaporated into the nothingness and everything is dollarized. So that might very well be the end game. But for markets to continue, for the system to continue, the status quo system to continue, the dollar must depreciate artificially, by policy, by strategic partnership and the allies doing whatever they do, and also by non-banks offering dollar creation processes. So now we have crypto markets where you could create dollars permissionlessly. And to top it all off, you got 3 completely immutable dollar liability implementations that will be born in 2023. So this is part of the narrative that's coming together for myself that starts in 2023 and leads into the next 3 years, simply going on 1985 to 1987. 3-year time horizon, dollar depreciation, couldn't breach a new higher high, lower lows, blow off top of extreme proportions.
Between Curve, Aave, and Liquidity, maybe to a lesser extent Aave and its GHO stablecoin, but it's still a credit creation process. It's still a dollar liability creation process. It's significant because there's billions of dollars worth of liquidity on the protocol that's collateral that people could borrow stablecoins against. So I see 2023 as the start of something very significant. And the confluence is there from the big macro successful investors to this giant blow off top on the dollar to the permissionless nature of crypto credit markets, global scale and scope. No one country is the gatekeeper at all. It's the perfect setup. So as folks are probably feeling pressured, frustrated by the overall financial system, can't get ahead, paychecks suck, consumer price inflation is up, the opportunity does not need to be expressed with degeneracy. You do not need to expose yourself to significant percentages of hype and meme coins. And you can dabble if you want. What do you turn $100 into $1,000? Does that really change a lot? I'm just saying. You don't need to engage in that activity. All of this data that I just showed you indicates you just need to participate in the actual financial enterprise that has been built over the last couple of years that is primed for global consumption in the next 3 years. Dollar declines are going to free up significant amount of global liquidity. How much global liquidity? More liquidity than ever. More liquidity than ever. And this isn't even the balance sheets. You know, Raul talks about there's a 97% correlation between the S&P and just global M2. And that's fascinating. Obviously, there's the lags, but cyclically, it's just all straight up. So there's you're going to have your volatility, which is going to be capital flow from underperformance to outperformance. But what's the strongest narratives in play? And the strongest narratives in play is probably fear. Fear of particular markets. Fear of regulation in particular markets. Fear of not being able to get credit in a particular market because of risk profile that banks have exposed themselves to. So where do you go? You go to a market that has no fear. There's no people. It's software. That has no risk management department. There's no underwriting associated with Aave. There's no underwriting on Curve. There's no underwriting on Liquidity. It's just deterministic execution of a predefined software program that extends credit, that does exactly what these companies are seeking from a banking institution. But they can't get it because the banking institution is not as safe. How about that? It's not as safe because these protocols require over-collateralization. These protocols don't have a risk management desk that says, oh, you guys are going to get liquidated. This protocol liquidates the shit out of someone in 5 seconds flat if it risks the stability, the integrity of the protocol. It has no emotion, no remorse. A person will just get liquidated immediately to preserve the integrity of the protocol. So my sentiment for the next couple of years is you don't need exposure to extensive risk or extensive volatility. You don't need the large returns. You're going to get extraordinary opportunity just being exposed to credit creation systems in the crypto markets. And there's more than just the ones that I talk about. There's many more. Even Abracadabra still has a role in all of this, and QiDao has a role in all of this, and there's stuff on Arbitrum, whatever the hell is going on in Optimism, and the stuff on many chains that offer credit creation. As simple as that. It's not the derivatives. There's plenty of folks that love the derivatives and the exchanges and that type of cash flow. But over the years, the most interesting thing to me was just Forex and now credit. So I had a narrative list at the end of 2021. It's like seamless cross-chain interoperability, dissemination of curves, monetary policy. I was so crypto-centric. I like the narratives. I stand by those narratives, and most of them came true. I mean, look at Layer Zero. That's just fire with Stargate. The transaction messaging volume is just all-time high if they're all-time high, but it's short-sighted in scope. Credit. Credit's the biggest thing that the crypto market offers. Dollar creation, dollar liabilities. Because dollar liabilities are accepted as payment, they are dollars for all practical purposes from a payment perspective. So this is a permission dollar creation engine. This is a permissionless euro-dollar system that is far beyond the scale and scope that the traditional euro-dollar system could ever cater to, because they were run by banks that had employees, that had real estate, that have underwriting and risk management departments and everything in between. This has eliminated all of that hierarchy, everything. So I say again, the biggest opportunity in all of crypto is stablecoins, because it is the macro situation. It is the core consideration of traditional finance, how many currency units exist and how many are being created. And that's how the traditional financial system remains existing and functioning. And that will be the primary focus, goal, intent of all political organizations, especially U.S. Fed, so on and so forth, the central banks, is to maintain the integrity and function of traditional financial systems for political reasons. Because it doesn't work out from a political reason, from a political perspective, if they can't pay Social Security. So I've been listening to Raul lately. I always listen to him, and his narrative's just so incredibly spot on. They print the difference between GDP and tax receipts every year. When US M2 ticks up, this is going to just do what we know it does. And in the meantime, China and Japan have foot the bill by debasing their currency, stabilizing global financial markets by offering extensive liquidity to such a degree that Japan alone accounted for Europe and U.S. currency unit contraction. Japan alone footed the bill to allow the ECB and the Fed to engage in quantitative tightening. Japan papered over the financial system to allow it to continue executing while the U.S. and the European central banks contracted the availability of country in the respective nations. And then China took it to a whole nother level. Boom! China just said, yeah, we're juicing it. They were juicing it, so they juiced it. Look what China did. So obviously, let's throw in Japan, and then I'll show you China. JPM2. So Japan flatline. They accounted for USM2 and European M2 contraction, and then you do CNM2. Oh, China. China just went a whole nother level than Japan. So China and Japan footed the bill, allowing U.S. and European Union to attempt to restructure the financial systems the way they think U.S. and Europe will be stable, better, whatever their intention is. Keep the system running, keep the lights on. So as the U.S. and Europe are forced to loosen policy allowing regulated financial institutions to extend credit and create currency, this thing's going to just go absolutely wild, especially considering when the US and Europe flip. Look at the relative price of the dollar. We have not seen M2 expansion that we're seeing now and likely to see much more in an environment where the dollar is relatively depreciating. Because the dollar has been relatively appreciating since 2008. That's the time frame that I give a shit about. I want to see a top. And that's where we're at. Look at the structure. Look at that blow off top. Candles matter. If this is a cyclical top, this is the bottom in markets. This is the bottom, the pico bottom in markets. Come on, if you see 5, 6, 7, 10 years of dollar depreciation and it finally gets down to a lower low allows the U.S. to continue doing what it does with the dollar. The blow off top and the other countries abandoned the dollar. And look, the dollar got to this price, 113 or whatever it got to. And that is what further caused the BRICS narrative. That the dollar getting expensive tells other countries they gotta get out. And that's not what the U.S. wants, at least not for the next 10, 15, 20 years. They want the system to continue operating as long as possible under the status quo regime. So I expect significant dollar depreciation over the next at least 3 years. I look forward to the interaction with the TWAP on the 6-month DXY chart. And I would not be surprised to see 5 to 10 years of just continuation to the downside cyclically. And then you have some bank blow up, and then you have a dollar rip to the upside. Look at these giant rips. So you'll have your volatility in the meantime, but look at the volatility between 08 and 2022. But generally trending downward. And that's going to produce some very interesting risk market activity, considering available currency supply, M2 supply. All right, I've been rambling. Let's do some comments and see what you guys are thinking. And over the next couple of streams, I'll hone in and solidify, narratives for 2023 and where I see things going. What I talked about in that tweet the other night. Tapsy, hello, Gazika, Joe, AI Doge getting wrecked. They're all going to get wrecked, and then they'll all rebound, and that's the way meme coins go. It's okay. Just, don't expose yourself to them if you don't want to, and it's okay not to. We talked about it this stream so far. Tapsy saw a stat by DeFi Llama. The current use of Uniswap was mostly recurring users, as opposed to mostly new users in 2021. Interesting. Someone corrected me the other day on Twitter. DeFi Llama is an aggregator of aggregators, but the aggregators that DeFi Llama surfaces are likely engaging with liquidity sourced from Uniswap. So whatever it may be, the liquidity is significant and the volume is very significant on Uniswap, and that's okay. What matters from my perspective is opportunity. Uni is completely uninvestable. LPing requires considerations that we've talked about before: size, how much of the LP do you own, so on and so forth, assessing vested interest and whatnot. But Bunny's the closest thing we've gotten to something investable with regard to the Uni narrative. How do you tap in to the liquidity of Uniswap? And that's why we took interest in Bunny. I think Uniswap certainly is not going anywhere, and that fits into the big picture. But then again, what's most pertinent is what opportunities are available to capitalize, and that's where we'll end with Uniswap for now. Staff, hello, Iad, Asun, Slendo, Daniel, good morning. Mr. Rational, what do you think of Chainlink? Cross-chain liquidity, and obviously Oracle data. Not interested from a staking perspective. I'm more interested in forex market activity. Um, the CCIP is interesting, but look, USDC has their cross-chain protocol now, so I'm not too interested in Chainlink. Oracle data is significant. Real-world assets are significant from a collateral perspective, and Chainlink is the type of product that facilitates that. There's others, there's competitors, and everyone will have the argument which is better, which is a better investment. And I invalidate Chainlink simply because I think other markets, other parts of the market are more significant from an opportunity perspective. I'm much more interested in stable coins, credit, and foreign exchange. Not too interested in real world data and generally the products that Chainlink offers. That doesn't diminish in any regard the significance of the products that Chainlink offers. And that doesn't diminish in any regard the potential for an investment that Chainlink offers. It just is something that I don't see fitting into the way I look at markets and want to capitalize on them. Kyle, what's up? Good to catch you live. A pleasure. Keep up the important work. Well, we try and tell good stories, significant stories, real stories about a market that if you ask mom and dad, grandma and grandpa, they'll be like, "What are you doing?" But we tell, we tell stories of business and enterprise and how and why it's really significant in the global financial system. KJV, you subscribe to Raul's idea that the BTC, yes, it was never about contraction and supply. That was just coincidence. Price up is purely a manifestation of available currency units in circulation available for investment. Price down is when someone needs currency units to pay for things. Everything and anything gets sold if you need dollars, period. So that's price down and price up. Obviously, the availability of supply is a factor in that, but price action is a manifestation of liquidity to invest and to buy assets. Because you're selling a currency unit to buy an asset, which means you don't need those currency units. If you're buying Bitcoin, it's because you don't need those dollars. If you need dollars, you're selling Bitcoin. It's a simple equation. So I think he's spot on about that. Very coincidental, the couple of year cycle of the halving. And it takes that amount of time, more or less, for policymakers to get things into a difficult enough of a situation where they need to significantly loosen policy to facilitate the currency creation process. It all reduces to liquidity and currency availability. That's what the Fed funds rate is. When the Fed funds rate is lower, it facilitates credit extension, which is creating currency units. Commercial banks in the United States create the money by extending credit. So obviously when we say credit contraction and banks are freaking out and banks are going bankrupt and banks' balance sheets are all screwed up, they don't have the capacity to lend someone $100,000, $1 million, a business $5 million. They just don't have the balance sheet availability. And we need currency units to expand and grow for the system to continue to pay for our obligations from a national perspective. So that's what really forces the entire hand of policymakers will be Congress and their required budget, their capex requirements for the fiscal year. And that's what this whole debt showdown is, debt ceiling showdown. Nobody wants to renege on obligations. No one wants to say, all right, we need a 20% reduction in Social Security, or a 20% reduction in the military budget, or a 20% reduction in Medicare, Medicaid. They want more. So to get more, they need more GDP. To get more GDP, you need more credit and more currency units and more activity and more productivity. But they haven't gotten more productivity even though they've created the currency unit. So they need to figure that out and cure malinvestment because they surely have a capacity to create currency units. So they need to finance productivity. So that's the whole conundrum that everyone's trying to digest. If the demographic changes, expectations, social structures, the whole kids not wanting to work or whatever folks are arguing nowadays, you still have the robotics backdrop. And whether it's a robot being productive or a human doesn't really matter. Productivity is productivity. As long as capital is financing productivity, it's not a malinvestment. So that's the real obligation of regulators at this point, in probably everyone's opinion, especially Raoul's. How do you cure malinvestment and actually finance productivity? And probably the answer to that is robotics. Why finance employees if they're just going to be expensive, more expensive than a robot doing the work? And have all the emotional baggage of a human. And then the other complexity from a political standpoint is how do you finance social stability, social order? And we get into stuff like, helicopter money, airdrop, stimulus, and other types of financing. Send people money every month, which is a result of the productivity of robotic employees. So this is how the world is changing. It's heading in this direction. So the conversation isn't to invalidate any of these things that are occurring. They are occurring. The conversation is the directionality and the trends. So the trend direction is dollar's going to have to come down to maintain the global order. Productivity needs to increase so the U.S. has a greater GDP. And if people aren't going to do the work, robots are going to do the work. And if people aren't doing the work, they need new forms of productivity to maintain sanity. You can send them money, but giving people money doesn't necessarily keep them sane. They need to be productive to a degree, at least contributing to community. And that's why I've argued that we have a labor crisis, and that's why things about Web3 catch my fancy with regard to gaming and different ways to contribute constructively to organized effort to community. And that maintains the social order. The robotics will cure the productivity. But we have yet to see a very clear picture of how we're going to maintain human psychological well-being. So that's very interesting. Critical Mass, I'm here. Sir Joe, present. Killis, good morning. It's been a nice turnout today. 34 people in the stream, 10 likes. Hit that thumbs up button. I really appreciate it. What else could we look at in the meantime? I keep my eye on currency recycling regimes on other chains. Velo was in a nice compression. But look at that. See? There goes that compression. That is a breach to the downside. Pretty much any way you draw it. That's a breakdown. So that's an invalidation. I mean, come on, it could have three highs couldn't break the higher high. Well, this is quite a bearish chart. Especially if it's a 3-day. Let's look to the daily. Especially if you have at least a couple of daily closes. A couple of daily closes below trend, but this is indicative of directionality. This is invalidation of the trend structure. This has been invalidated from a potential bullish continuation. Convex is still quite depreciated. Where's our accumulation zone? I'd say that's about it in my opinion. You obviously got the lowest of lows barring this wick, and then we got a decent previous support. So a breach to previous support, and this is your discount zone. $1.80 to 440. That's a decent accumulation zone. Liquidity is something I don't have a position in. I kind of wish I did. But obviously the fact that I have not acquired a position has been favorable to me. This is extremely volatile, and this is something that should probably depreciate. I don't see any supports. I mean, maybe the $1.50 range, maybe. But it's irrelevant. That there's the short term, we're probably going to see continued volatility. So we'll continue to see assets get into discount regions. 60 cents. Be nice to see it fall back down to the 60-cent region, and that's a nice accumulation zone. You want productive assets at a discount. Now, how productive is this asset relative to other assets? Now, it's less productive, but it's systemically significant from a functional standpoint. What does it do? What does it offer? It offers permissionless credit creation using a wonderful collateral asset that also is quite productive and happens to be very significant in the Ethereum financial market, the emerging market of the internet. So it's significant, but it's not necessarily as productive as other assets like the curves and the auras and even the balancer for that matter. And there's plenty of other stuff going on Arbitrum. I'm not too excited about the L2s. So if you guys make your money on the L2s, go get them, have fun, be safe, bring your capital back to mainnet for guaranteed finality. Let's check out liquidity. We'll drop the stream on liquidity. Marginally positive sum across all markets. Ethereum mainnet still negative. Let's see how Arbitrum's doing. Marginally negative, but look at these wicks to the downside. Everyone was so bullish. There was so much activity with the ARB airdrop, but look at these wicks of capital outflow. $62 million, $25 million, $20 million, $13 million, and most recently yesterday at $22.56 million. Why would capital come out? Capital comes out because people made a shitload of money and they're taking millions of dollars out. So how do you make money? Money makes money. It's much easier to make money with big money. It's much harder to make money with small money. So keep that in mind with regard to who you're engaging with on these other protocols where big money is smaller than on mainnet. A couple $1 million on Arbitrum goes a long way and you're able to capitalize significantly. You know, folks are like Pepe, 10,000% returns. If you throw around $1 million on Arbitrum and make 20% in a day, you just made 200 grand in a day off 20%, and folks want 10,000% on these meme coins. So expectations, peers, vested interest, that's who you're playing against. You're playing against folks that have a huge amount of money. This is why I bring up that biological narrative all the time about the little fishies that swim with the sharks. But look at these capital outflows. People have been capitalizing, and who are they capitalizing on? Probably not capitalizing on peers. They're probably capitalizing on smaller fish. Optimism. $15 million, two $15 million outflows out of a $639 million ecosystem. So that is a large capital drawdown, 5.65%. You know, good part of that explains exactly what we're seeing with Velodrome. That's a lot of sales, a lot of outflow. So folks think it's bullish markets. It's a bearish market. Every capital is still draining from these chains. Avalanche, let's take a look. I have a high opinion of Joe, Trader Joe. Whether you could get an opportunity, whether you see a financial opportunity,
price point, liquidity availability, which chain, all the considerations. That's another story. Separate that process. You could identify something of interest, something of significance. Doesn't mean there's a financial opportunity. The best technology is not necessarily the best investment. Always remember that. Big outflows, 1.24 bill, but millions of dollars of outflows. Relatively slow volume. I wonder what the volume is on the chains. Let's go over to DeFi. Oh, we could see. Avalanche. That's not volume. Volume has its own page. Volume. So let's just look at volume and Arbitrum. That's probably, where did Trader Joe? Look at that. Look at the volumes crashing. This is why there's capital outflow. There's less opportunity, less volume, less price action. All right, I'm out. They're bored. People are bored, and they take their money back to safety, especially their gains. That's a significant decrease in volume. 33% decrease in volume. Polygon. Polygon might be the next market in the short term that has some bullish activity. Uptick in volume. It's still relatively low historically. Some nice spikes here and there. I want to see Avalanche. There we go. Avalanche is at the end. Ooh, look at that volume down 56%. Where's optimism? I can't even select it. I have it selected. 31%. 31.82% on the week. Let's go to mainnet. 11%. Look at that. From a volume perspective, mainnet is outperforming. Mainnet has the increased financial activity. Outperforming to the downside, of course. There's more financial activity on mainnet, less of a decrease in financial activity on mainnet as compared to the L2s. $7.57 billion worth of financial activity. Let's go back to stablecoins for a second and look at Ethereum mainnet stablecoins. 69.92. I remember seeing this much higher, $73 billion a couple weeks ago. Tether still significantly outperforming USDC, up 2.9% for the month, down 7.3% for USDC. Market cap for Tether on mainnet's 32 and 25 for USDC. How that's going to all play out, because Tether's offshore, USDC is obviously going to be an integral component of U.S. domestic Eurodollars. I mean, literally by backing USDC with treasuries is the definition of a Eurodollar. The extension of a currency liability with collateral backing. I mean, come on. That's the definition of currency creation process. What is currency? That's why I talk about all this shit on Twitter. What is currency? What is money? This is money. If you could spend it in a store, it's money. If you could walk out of a store without someone calling the cops on you, it's money. USDC is money. And for now, for the foreseeable future, this game is scored in dollars. So don't forget that when you're doing a little bit of risky behavior, playing around with your favorite meme coin. Just remember, it's scored in dollars. So more dollars is better than less. And the name of the game is survival. So if you're at the end of your rope and you're feeling degenerate, don't do it with all your bag. Don't do it with the whole portfolio. You do it with 1%. 1% to 10% changes everything. 1%. You're going to survive if 1% goes to zero. 10% to zero. That hurts. 10% to 5% hurts.
Play around with small percents of the portfolio because all that matters is survival. And all that matters, why do I say this the most? Because if you're just getting into crypto now, if you're just figuring all this stuff out, this is a business, meaning you go to work, you get a paycheck because you're doing work at your place of business. You're sitting in front of YouTube right now. You're clicking on TradingView or DexScreen or DeFi Llama, Twitter. You're engaging in activity. It's a business, and you're optimally profiting from that business activity. So figure out the rules of your enterprise to be profitable and not lose money. So you don't have to be degenerate. This is an actual financial market. Let's wrap it up, ladies and gentlemen. Mind over body. Hope all is well. Thank you very much. I appreciate that. Daniel asks, what's your general outlook on traditional markets for the next 3 to 6 months? How are we not going to see some sort of credit event? I mean, how are the smaller banks lending anything? You can obviously look into the books of the individual banks, and that'll drive you nuts. That's some Michael Berry shit right there. But, this ends with the job cycle, the job market, and unemployment. That's how, and then the Fed pivots, and then something collapses, something completely breaks. So it's not the decrease in rates that everyone should be looking for. If they increase rates and they continue patching things, I don't know. I expect significant volatility over the next 3 to 6 months. Significant volatility. That's my expectation. Does it come? I don't know. I don't care. I have the exposure and the structure that mathematically guarantees my survival. I will be in this market with capital in 5 years, in 10 years, in 15 years. Not having to worry or think about what the market is doing. I allocated to enterprise that will continue to exist, that will not go bankrupt. They cannot go bankrupt. So the valuation of the things that I own will be volatile. The productivity of the things that I own will be volatile, but they will remain productive. The price will be there. It's not going to evaporate into nothing. And then in 3, 4, 5, 10, 15 years, I will be able to see how well my choices were, how well these conversations I've had with you have served me. Because this is my conversation. This is my story, and I think this story is a good story. I think it's such an exciting story. And I say that as a parent for my kids. So make good choices. Take less risk. Play around with less of the portfolio and survive. It's the most important thing. What's your take on FOMC meeting Wednesday? 25 basis point bump. And markets are addicted to rate change directionality. What that does to the bond market, I expect higher rates, decreased collateral pricing, and that should increase currency availability internationally. Cheaper collateral means it's easier for Eurodollar printing outside of the U.S. Keep an eye on M2, just as Raul talks about and now I talk about. It'd be nice when you start to see US M2 pick up, that's when the markets are going to start to be fun again. A little bit to the lesser extent of European M2, but it's just fascinating how Japan completely just unto itself accounted for US and European M2 contraction. The question probably is what time horizon for US M2 to start ticking up. It's not going to tick up in this environment. A credit contraction, you have M2 fall off a cliff. But bear in mind here, let's look at one more chart. One more chart, ladies and gentlemen. US M2 would need to contract like 15, 20%, 30%, whatever the hell that percent is. It would need to contract from here. April 20, there we go. 25%. Do you know what would happen to GDP if US M2 contracted 25%? We wouldn't have an economy, and you need guns and ammo and hunting equipment. It would be an absolute post-apocalyptic scenario if M2 in the US contracted by that much. This is how much more currency is in circulation just in the US since 2020. And this just highlights how much more currency in the world is needed. The reason for all this instability is the lack of currency to create the financial activity, to create the nominal tax receipts, to stabilize governments and allow businesses to continue trying to be productive. They're barely productive. GDP growth, as Raoul talks about, has been stagnant. So we need a productivity revolution, and they're not going to do it financially, but they can finance it. The consumer price inflation isn't necessarily a manifestation of increased currency in circulation. That's just the malallocation, and the problem with that is it's based on humans, and humans allocating the currency supply, and that's always been the problem. You need an elastic currency supply. You need to be able to increase currency in circulation. This whole fucking thing to work. The problem is the people. And that's why one of the biggest narratives I have in the crypto markets is immutability. Get people out of the equation. People are the problem. Last question. Do you like the narrative behind Layer 0 AMMs? Well, Stargate technically is somewhat of that. I believe you could swap from USDC to the ETH on the L2s. Sure, that was my 2021 narrative of seamless cross-chain liquidity provisioning. You're on Ethereum, I could make a transaction from Ethereum to USDC, and it sources liquidity, and Arbitrum goes to Optimism and comes back to mainnet. And I was just operating on mainnet, my network of choice. So it's a big deal. But can you capitalize on that narrative? I don't think there's any significant way in my mind to capitalize on that narrative other than all the shit that we talk about. You want transaction fees. You're going to want to expose to a currency recycling regime, of which there's only a couple. There's how many currency recycling regimes that actually have somewhat of a federation to establish some degree of strength and support and momentum? There's only a couple. So it's not like something new is going to come along. They've tried it on mainnet. Look at how well Solidly is done on mainnet. It's done no currency recycling. It requires the third-party federation of consumers. They did not come. So I don't think there's much opportunity other than maybe exposure to Stargate. So keep it marginal. I think my exposure was 1% all those months ago. And that's depreciated, but it is what it is. That's the position I chose, and I will live with that position. It's enough exposure. Let's see what comes with Layer 0. I mean, Layer 0 is much more than just cross-chain liquidity provisioning. That's just seamless cross-chain completely. So Layer 0 is very, very interesting cross-chain messaging technology, which facilitates the cross-chain swaps. Thank you all for joining me today. 40 people in the stream, 14 likes, 12:45 p.m. on a Monday, May 1st. Tell everyone to subscribe. Thank you for sticking with me to the end. After party on Discord for the most rational community in the entire crypto space. Stay rational out there, boys and girls. I'll see you next time. Peace.